Welcome back, students. So we'll be looking at tax permissible items. Tax permissible items. There are specific items that are tax permissible, which are emphasized by the tax law. These specific items that are tax permissible or allowable are highlighted below. So we're looking at items that are allowed under the tax law, under the CITA. So those things that are allowed for deductions and to be deducted from the income according to the tax law. 1. Donations. The Company Income Tax Act, for instance, specifies among other things the conditions to be satisfied before any donation can be permissible. Thus, donations that do not satisfy these conditions are not tax permissible or allowable. These conditions include, so we're looking at the donations because for most often time company incorporate donations as part of their expenses. So we're looking at the condition to be met before such donations will be allowed according to the tax authority as an allowable expenses. So these conditions include: 1. Donation must be made out of profit of the entity. Therefore, if any entity makes a loss, whatever donations paid during that year should not be treated as an allowable expenses. So where a company uh, donate any money to a particular organization, or so the donations must be out of profit. In a situation where the company makes a loss and still donated to some organizations, such donations won't be allowed as an allowable expense. It will be seen as its allowable expenses. 2. Donation should not be expenditure of the capital nature. For capital nature expenses and expenses that last for more than 1 year. So it should not be of capital, it should be of revenue expenditure. 3. Donations must be made to any of the approved bodies, e.g., Boys Brigade, Boy Scouts, Girl Guides of Nigeria, Red Cross. So there are some approved bodies that companies must make donations to. It's not just donations to any organizations or any association. So it's the approved body. So any donation that is made to organizations or associations outside the approved body won't be allowed won't be allowed as an allowable expenses. For any year of assessment, the maximum amount allowable is limited to 10% of the total profit of the company before deducting the donation. So donations must be the maximum amount that can be deducted is just 10% of the total profit, after which before deducting such donation. It is worthy to note that donations, whether revenue or capital in nature, made in respect of university and other tertiary or research institutions for research and developmental purpose, or as an endowment out of profit of the people of the period of an entity, shall not exceed an amount which is equal to 15% of the total profit or 25% of the tax payable in the year of the donation, whichever is higher. Donations to anybody or institution whose name is not included on the list of the fifth schedule shall not be treated as an allowable deduction. So we're looking at those organizations that is being listed on the fifth schedule. So any donations that is made outside those organizations will not be allowed. So I encourage you to take your time to critically look at those organizations that are allowed for that are permitted to receive donations according to the tax law. The fifth schedule funds bodies and organizations in Nigeria to which donations may be made under the Act include: 1. Youth or philanthropic organization. These youth or philanthropic organizations include Boys Brigade, as I mentioned earlier, Boy Scout of Nigeria, Girls Guides of Nigeria, Nigerian Red Cross, National Youth Council of Nigeria, Nigerian Youth Trust. B. Religious bodies. The religious bodies that donations can be made to include the following: Christian Council of Nigeria, Islamic Education Trust. So any donations to any church, for instance, donations made to uh, Young and Grow Church is not permitted because it does not fall uh, under the fee schedule. So donation that will be allowed is donation that is being made to the Christian Council of Nigeria or the Islamic Trust Fund. Also, C, medical. Any hospital owned by the federal or state government, university, university teaching hospital, or any hospital which is carried on by a society or association otherwise otherwise than for the purpose of profit or gains to the individual members of that society or organization. So any hospital, be it federal or state, or probably any university teaching hospital, or any hospital carried by society or association for the purpose, when the purpose is not for making profit or gains, would be also permissible. So educational sector now. The following are the donations exempted from tax to educational activities. 1. Institute of Medical Laboratory Technology, National Library, National Braille Library of Nigeria, Van Lee Nigerian Educational Trust, the Institute of Chartered Accountants of Nigeria Reading Fund, Nigerian Accounting Standards Revenue Service, Peterson Zocconi's Nigerian Technical Education Trust Fund, Education Cooperative Society, any education institution affiliated I come again, any educational institution affiliated under any law with any university in Nigeria or established under any law in Nigeria, and any other educational institution recognized by any government in Nigeria. The next point, a public fund established and maintained exclusively for providing money for the acquisition, construction, maintenance, or equipping a building used or to be used as a school, college by the federal or state government or by a public authority or society, association which is carried on otherwise than for the purpose of profit or gain to the individual members of that society or association. E. Relief Fund. The following are tax allowable with respect to relief fund. 1. South African Relief Fund, Southern African Relief Fund, National Commission for Rehabilitation. 2. A public fund established and maintained for providing funds for the construction and maintenance of a public memorial relating to the Civil War in Nigeria, which ended on 15 January 1970. Any public fund established by the federal or state in aid of or for the relief of drought of any other natural disasters in any part of the federation or state will also be permissible, e.g. ecological fund. Now for research now, the following are tax allowable with respect of research. 1. Nigerian Institute of Trypanosomia Research, Nigerian National Science and Technology Fund, Nigerian Institute for Oil Palm Research, Nigerian Institute for International Affairs, National Council for Medical Research, Cocoa Research Institute of Nigeria, National Science and Technology Development Agency. Now, so it's a welfare now. The following are tax allowable with respect of welfare in the country. 1. Musical Society of Nigeria. 2. Rotary International Polio Plus Program. 3. Training centers and residential schools for the blind in Nigeria. 4. Associations of Society for the Blind in Nigeria. 5. Society for the Blind. Next, Nigerian National Advisory Council for the Blind. Nigerian Society for the Deaf and Dumb. So if you observe that most of these organizations or associations, they are of national importance. It's not just for a private organization or what it has. For instance, most of them have the name Nigeria. They also have the name national in in part of their names. So please take cognizance of that. Also, we also have the National Sports Commission and its state association. We also have a public institution or public fund comprising of the Armed Forces Comfort Fund, Navy or Air Force established or maintained for the comfort, recreation or welfare of its members. Now to foundation and endowment fund. Foundation and endowment fund. The following are tax allowable with respect to foundation or endowment funds in Nigeria. 1. University College Hospital Endowment Fund. 2. Afri Prince Foundation Limited. 3. Kawal Farm Sharia Foundation Limited. Others. There are other funds or activities not classified in any of the above, but they are tax allowable, such as Nigerian Museum and Nigerian Conservation Fund. Now to development. Research and development. Sorry. The allowable amount relating to research and development manifest in two folds in Nigerian tax law. The two-fold section of the Nigerian tax law that dealt with research and development can be summarized as 1. Actual expenditure on research and development are allowable allowable deductions in accordance with the provisions of the Act. So any expenditure incurred on research and development are allowable if it met the requirements of the tax law, of the provisions in the act rather. Also, reserve made out of profits for research and development expenditure are allowable deductions from profits subject to a fixed maximum. It is worthy to mention here that the Nigerian tax law provides 20% investment tax credit on the qualifying expenditure of companies and other organizations engaged in research and development activities for commercialization once the expenditure are incurred for that purpose. So, the tax also gives an incentive, a tax credit of 20% to any organization or company that incur a qualifying expenditure on research and development with respect to commercialization. So once the expenditure is being incurred on that, they will be granted 20% investment tax credit. B. Rental charges. Rental charges in respect of residential accommodation occupied by employees of the entity are allowable up to a ceiling of 100% of the basic salary of employees. C. Property holding companies. The allowable deductions for property holding companies are limited to expenses attributable to maintenance of the property concerned, and the other one is directors' remuneration up to 10,000 naira per annum per director, payable to a ceiling of 3 directors in any one company. So what they're saying there is that under property holding companies, any company that have property in several places, for deductions to be allowable, expenses that are attributable, that are related to the maintenance of the property are permitted under the tax law, and also directors' remuneration of 10,000 naira per annum, and must be limited to only 3 directors. Such expenses will be allowable under tax law. D. Repairs and renewals. The usual items under this heading are those expenses incurred in maintaining the earning capacity of an asset of the entity. In line with the above, the keeping of such asset is in good working condition is very important for the entity to acquire profit. As such, costs connected with such exercise must by reasonable expectation be allowable deductions. So any expenses incurred in the maintenance, in the repair and renewal of asset of the license would be allowable as well. So now let's move to bad and doubtful debt. The striking issues to observe with respect to the treatment of bad and doubtful debt for the purpose of tax include: 1. They must relate to debt incurred in the ordinary course of business. So any debt that is not incurred in the ordinary course of business, that is outside the scope of the ordinary course of the business, will not be allowed. So the debt must be within the ordinary cost of the business for that particular period of time. They must they must be identifiable to specific debt. This means that general reserves against bad debt and doubtful debt are not allowable. So where debts are generally reserved, where debts are of general in nature, such debts would be allowed for tax deductions. But where debts are identifiable to specific debt, they will be permissible under the tax law. Reserves no longer require are taxable if previously allowed. Debt previously written off, allowed in tax computation, and later received are taxable as income. So where debt is probably written off from the P&L account and is allowed under the tax computation. So where the debt is being received now later, so it should be treated as an income. Do you get that now? As an income for that particular period. So and later received are taxable as income for the year in which recoveries are made. So if, for instance, in 2014, a debt of 50,000 was written off as an expenses, and in 2 years' time, let's say 2016, I recovered such debt of the exact amount of money. So that 50,000 naira would be treated as an income in 2016, and it will be uh, taxable under the Company Income Tax Act. Necessary evidence must be provided at the request of the Revenue Service to prove that the debt have become bad or estimated to be doubtful of recovery. So let's quickly look at non-allowable expenses. We've taken our time to also consider allowable expenses. So let's quickly look at non-allowable expenses. Apart from the class of expenditures referred to as allowable expenditures, We also have another class of expenditure called disallowable expenditure. So it can also be referred to as disallowable expenses. So if it so you can refer it to non-allowable expenses or disallowable expenses, which of the two is permitted. Or reductions, which again is applicable to both companies and individuals. Disallowable expenditures or reductions are those unaccepted expenditures or deductions that may have been provided for or deducted from the income or revenue of companies or individuals as reflected in their financial statements or accounts. All such expenditures, when added back, tend to increase the taxable income of taxpayers, thus increasing the amount of the tax revenue of the government. They are also used as tools of government to shield against tax evasion and avoidance. So the idea behind uh, non-allowable expenses or deductions or disallowable expenses is to ensure that the taxpayer does not uh, play smart or to um, prevent them from evading tax and avoiding tax. So there's some expenses that if the tax authority does not critically look at those expenses, they are going to the taxpayer is going to bring that in and probably do such expenses permissible under the accounting standard. The taxpayer is going to bring that in order to reduce the amount of profit and thereafter reduce the amount of tax that would be paid for that particular period. There are certain expenditures that are not permissible or not allowable for that purpose of tax. Accordingly, these expenditures are added back to the accounting profit during the course of determining the assessable profit, as I explained earlier, by the provision of the relevant tax law in Nigeria. The following are items or expenditures that must be allowed. One, capital be paid that must be disallowed rather, or that are non-allowable. Capital be paid or withdrawn and any expenditure of a capital nature. One, any sum recoverable under an insurance contract or indemnity. Two, three, taxes on income of or profit levied in Nigeria or elsewhere. In case of tax levied outside Nigeria on profit which are also chargeable to tax in Nigeria and double taxation relief is not available, such tax would be an non-allowable deductions. That is, any tax on income levied in Nigeria or elsewhere is not permitted to be deducted as expenses under the CITA. 4. Payment to unapproved pension, provident, savings or widows and orphan society fund or schemes or development or education fund. So since it falls under unapproved pension or provident, this is the one under the unapproved part. It won't be treated as an allowable expense. Sorry. Now, another area is the depreciation of any assets. Capital allowance are granted instead are granted instead. Yeah, we'll look at this when we get to capital allowance. But 6. All appropriations for profit, namely dividends, general provision for bad and doubtful debt, write-off of preliminary or formation expenses, and expenses on issue redemption of shares and other securities. So any expenses that fall under this category won't be allowed under the tax law. So please take your time to critically look this and understand and try to put this thing in your memories because they're going to reflect in any likely question. So you must be able to differentiate between allowable expenses under the tax law and disallowable expenses. Any expense of any description incurred within or outside Nigeria for the purpose of earning management fee unless prior approval of an agreement giving rise to such management fee has been obtained from the minister. Next, any expense whatever incurred within or outside Nigeria as management fee under any agreement entered into except to the extent as the minister may allow, and any expense or any description incurred outside Nigeria for and on behalf of any company except of its nature and to the extent as the revenue reserved may consider allowable. So let's quickly look at the computation of company income tax, the normal basis for computing income tax. The Company Income Tax Act (CITA) provides that companies' income tax shall be levied and payable for each year of assessment. So every year, companies are expected to pay tax on profit that is being realized at the rate of 30 kobo to every naira in respect of a company's total profit. This means that income tax payable, that is for every naira a company generates as profit, would would be liable to tax. I believe it will, for every naira, 30 kobo of it will be liable to tax. So for every naira generated, that is for every 1 naira generated, 30 kobo will be paid as tax, while the company is left with 70 kobo. This means that income tax payable is charged at the rate of 30%. So this is the fixed rate of a company's total profit for an assessment year. To assist readers, the format of the computation of company income tax is stated below. So this is a standard format in preparing the company income tax and for adjustment. So according to section 27. So let's start. So this is the format. So the profit as per account, the profit given to you from the account, or the net profit given to you, the net profit given to you, or it can also be the profit before taxation, depending on how the question is being served to you. So the total amount, are going to add back all disallowed expense. So every item that are disallowable, as I explained to you, I told you that you are going to add them to the income. So for example, depreciation is not allowable. Capital expenses on shares is an item of disallowable expenses. Rent disallowed. Donations to unapproved organization or association is not allowed as well. General provision for bad debt. Don't forget that I mentioned that it's only specific that will be allowed. General will not be allowed. So that when there is diminution in value of investment, it will also be disallowed. So when we do that, we're going to add them together, then it's going to give us this. Then we're going to add it with the profit as per account. Therefore, our profit is going to increase. So also, we're going to list income that are not taxable. For instance, profit on sales or fixed assets. It does not, and they are not taxable because it does not involve the movement of cash. Profit on export sales as well won't be allowable. Other non-taxable incomes like interest on agricultural export loans, all these, to mention a few, are not allowable. All these income are not allowable under the tax law. So I'm going to deduct them. We'll deduct them from what we've gotten from the profit. Then we have our accessible profit or adjusted profit. For depending adjusted profit. So adjusted profit precedes accessible profit. Then we'll deduct our education tax of 2% of accessible profit. I say any value, the value of what you get here is subjected to 2%. Give you this. So then continuation, having gotten our adjusted profit, then where there's balancing charge, we're going to add a balancing charge. We're going to add balancing charge. Where there's loss relief, the loss will be brought forward, and if it's able to be relieved from the profit, if everything is able to be relieved from the profit, we're going to relieve it from the profit. We're going to relieve it from the profit. Relieve it from the profit. So when there's investment allowance, we're going to deduct it as well. Deduct investment allowance as well. So we're going to our value is going to reduce to this. Then capital allowance, the initial allowance we got, total initial allowances, annual allowance, balance allowance. It's better we prepare them in a schedule so that we just incorporate the exact total amount of money. So when we add them to everything together, yeah, according to the tax law, it said for every year the amount of profit that must be made, the amount of allowance that must be deducted from the profit must just be just be 66 to third of the assessed profit. So it must not exceed uh so where a company makes a profit of 300,000 naira. So the tax law is saying if the capital allowance computed is assuming is 250,000 naira. For instance, we have 300,000 naira here, 300, and the total capital allowance, if we add both our initial to our balancing allowance, we are going to have sum of 250,000 naira, 250, 250. And what the tax law is saying here is that now the capital allowance that will be deducted from the profit must be restricted to third of the what of the assessable profit. So the third of the assessable profit is that's two over 100 over 3 times 300. 300. That gives me six. That gives me 200. So the company will only restrict. Is only permitted to uh the third capital allowance of 200,000. So 200. While the 50,000 naira, which is the balance, would be carried forward to next year to relieve from future profit. I believe you get that. So that is the idea behind restricted restriction of capital allowance to 66 to third of the assessed profit. So capital allowance brought forward. So the 50,000 naira, I believe we are following. The 50,000 naira would be carried forward. So we're going to have our total profit thereafter. Our total profit. Total profit. So this is the total profit. Having the third capital allowances, our loss relief, we've added our balancing charge. The total profit gives us this. So we thereafter compute our tax liability, which is 30% of the total profit, and it's going to give us this value. So this will be our tax liability for that very year. So therefore, also we're going to add the child education tax before deducted from the assessed profit. We would add the last 20% of the assessed profit, which gives us this. Then we add this with our company income tax. So our total tax payable, the total tax payable for that period would be this. So we continue in the next class.